Hey, my next guest is a dividend growth investor, and we're going to put something on your screen, right, a chart that will underscore why. $100 in dividend growers and initiators in 1973 would have been worth $14,000 by the end of last year, up 300% more than the equal weight S&P during the same time frame. So let's bring in Bahnsen Group Managing Director David Bahnsen. David, before we get to the dividend strategies and things like that, I want to get your thoughts. This market, it seems to rebound just when you start to say maybe there's some cracks in the armor.
Yeah, it's a funny thing about valuation. It makes everything skittish, but it can be upside skittish as well as downside. A little bad news causes people to sell off. A little good news makes them run back in. Charles, there's too many people in the market right now that have never seen it go down and stay down for more than 5 or 10 minutes.
Right.
That's what I'm concerned about. Valuations are rich. There's skittishness out there.
And on that note, then, and I think I had this conversation somewhere today, the notion that we're due, maybe just sort of due, and I mean, it's not scientific per se, but you have a certain amount of pullbacks during every bull market. You have a certain amount of corrections. Are any of these things just sort of on the radar just simply because, it hasn't happened in a while?
Yeah, it's not something I'd try to time. I want investors to have a better plan than just we're due, right? But you're right. There is a sense in which it's inevitable. You never want downside to go away because it means the upside is going to be a lot less. There's a risk premium around that volatility. We demand more return as stock investors because of the volatility.
Right.
I think there's some overexpensive things that I believe could get more overexpensive, but they're not yet.
Right. Let's talk about dividends, right? So values had a rough, tough go of it, and a lot of these dividend ideas are sort of in the value bucket, the aristocrats, so to speak. Obviously, you're different. You do dividend growers, right? In fact, year to date, I know 14 of 29 of your positions are up 25%. But there is a perception out there that dividend investing is no longer works.
Yeah, and again, 14 of 29 are up 25% or more. Some are up 50, 60, 80. I think that the notion of aristocrats, where it's a very low yield, but it's growing every year, is very different. That can do really well in a bear market, by the way. It could be a very defensive strategy. But no, the financials, the energy names, I mean, financials are the best performing sector this year. And you look at Morgan Stanley up 40, you look at JP Morgan up 50, Blue Owl Capital up 65, Apollo up 85%. That's not defensive. These are really proactive names that are growing and pro-cyclical in this economy.
And supposedly going to get a bump from, getting Basel III and those kind of the things that were hanging over their heads. Hey, I was shocked when I read that you own some Broadcom. In fact, you've owned it for a long time, and you were considering you're debating whether or not to hold it. Yesterday, the CEO said that the AI spending frenzy is going to continue. In fact, I think his quote was, everyone's investing in a full tilt. This morning, Morgan Stanley raised the target. Almost every morning, someone's raising a target on it. So you must have some huge gains to even be considering taking this off the table.
Well, it's massive gains. We've owned it for about 5 years, so you can do the math. But as a dividend grower, we're getting almost 30% per year in dividend of what we originally paid.
Right.
But a new investor is getting 1%. That's the problem, is I don't want to hold a stock that I wouldn't be buying. So am I comfortable still buying it? If what he says is true, they would be growing the dividend. They just grew at 11% this week.
But the dividend is not their priority, though, right?
Well, no, but it always has been. They were a 4% yielder. So they did not become an accidental low yielder. They've grown the heck out of it.
But they're a player now. They're a player in some other areas.
And so if the cash flows are real, the dividend will grow with it. And this is the whole point of my philosophy, Charles. CEOs that say stuff like that have a chance to put their money where their mouth is. You can grow the dividend if you're anticipating the free cash flow he's talking about.
We only have 30 seconds. I want to let the audience know some of the ideas you like are Amgen, Pepsi, like you with Sam, and Chevron. So let me just pick on Chevron for a moment.
Yep.
The oil market, just at least West Texas Intermediate oil, it hasn't made the move I think many anticipated. A lot of geopolitical shocks have happened, and it just hasn't moved the needle. China's had stimulus packages, and it hasn't moved the needle. What's going to move the needle for oil?
Massive mistake to think that Chevron should be linked to the price of oil. They make more money at 70 than 90. 90, you get demand erosion. 70 is an
sweet spot.
Extremely
no pun
profitable.
intended.
Yeah. The Permian Basin, they're making tons of money at 70. And there's tons of consumption. 90, you you erode demand.
Right.
So these big oil companies, and here's the other thing, Chevron did it with Hess. That deal closes next year. They did it with Noble in the middle of COVID. They bought competition. They bought market share on the cheap. And those things come back to benefit, the way Exxon did with Mobil.
Right.
These are major M&A players. Chevron right now, the price is down more than, like Exxon's up on the year. Chevron, to me, is just a good value with a 4.5% yield. It's still up huge, but lots of growth in front. You're going to be paying 11 times earnings, not 23 times earnings.
You know, I learned something every time you're on the show.
Thanks, my friend.
Merry Christmas.
Merry Christmas.
Thanks.